Hi, and welcome back to this series on investing. We're going to continue in part 2 of chapter 5, Modern Portfolio Concepts. And this second half, we're going to talk about the capital asset pricing model. So this is going to use various statistical measures to help calculate the required rate of return for an asset. So we know that diversification cannot entirely eliminate risk. So from an investor's perspective, risk is not something we want. And there is a certain amount of risk that is undiversifiable. So we're going to talk about the components of risk, beta, as a measure of undiversifiable risk, and how we can use the capital asset pricing model in relationship with beta, give us help us calculate what the required rate of return would be on the stock with a certain amount of risk as measured by beta. Now let's talk about two different types of risk. We have diversifiable and undiversifiable. Now, diversifiable is sometimes called unsystematic risk. So this means that by adding together multiple different assets, we can reduce risk in a portfolio. So it means that the risk can be lowered through diversification, meaning buying 30 different stocks and putting them together, you have a diversified portfolio, which would be less riskier than owning one stock. And you can kind of think of that as 30 different companies have 30 different sets of management, 30 different sets of different businesses, customers and suppliers. So the chance of all of them doing bad in 1 year is pretty small. And again, we're looking at results that factor from, it could be a single asset or a handful of assets. Now, the undiversifiable or systematic risk is a type of risk that you can't reduce by increasing the amount of assets within your portfolio. So this risk is going to remain no matter how well diversified your portfolio is. So there are certain risks that live and affect all stocks in the stock market. And we're going to go through these different risks, but the most common ones would be inflation, interest rates, economic growth, and this is sometimes referred to as a market risk. So you can't escape the market risk. So the total risk would be the undiversifiable plus the diversifiable risk together would be total risk. So it's just interesting to know. We talked about some of these separate risks last time in the previous chapter, that some risks are going to be faced that are specifically the company risk, like business or financial risk, and some risks are going to be a market risk, something that affects the entire market. Okay, so beta is going to be a measure of the undiversifiable risk. So the beta factor is really the measure of the market risk. And it's a number that's going to quantify this undiversifiable risk. And for this class, we don't have to worry about actually calculating beta. Beta will always be given to you. But it's going to indicate how a security's returns are going to respond to changes in the market. So as far as deriving beta can be derived in a graphical sense by plotting the coordinates of the return of the stock at various points. So using time and statistical techniques, we could calculate an equation that's going to solve basically looking for the slope of the equation. So the equation for the straight line is going to be y equals mx plus b, but the slope we want to solve, or we want to know what the slope of the line is, and the slope is what beta is. So it's the m of the equation. So let's look at a graphical representation. And like I said, for the purposes of this course, we're not going to actually be mathematically calculating beta. We're just trying to interpret beta for the utilization of creating portfolios and for its influence in the capital asset pricing model. Now, so here, let me make this a little bit bigger, so it's a little bit visible. Okay, so we could look at, here's Bank of America and here's PepsiCo, two different stocks. You see how the incline here of Bank of America has a more steeper slope as measured by the rise over the run compared to PepsiCo, which has a slope of 0.6. So the smaller the slope, which would be a smaller beta. So beta is denoted by this kind of script-looking B here. So this is the beta of Pepsi is 0.6. The beta of Bank of America is 1.2. So Bank of America is twice as responsive to the market fluctuations as PepsiCo is. So here is the market changes from negative 20 to 20% returns, and then they're just plotting if the market goes down 8%, Bank of America is going to go down at a different rate. I'm sorry, this is Pepsi. It's going to go down at a more aggressive rate. So where PepsiCo would go down at a less aggressive rate because of the smaller slope. So it just basically says the smaller the number here is for the slope, the less reactive the stock will be to market fluctuations of return. And these blue and the green dots are just plotting each of these stocks at different points on the scale. So if we, depending on the market return to the stock return. So we're just can get a sort of a graphical look at that. Okay. Let's go back to our regular size. Okay. So looking at, let's continue with beta as a measure on diversifiable risk. So remember we talked about the correlation coefficients in the previous slide. So beta is sort of related to those correlation coefficients, but it doesn't stop at -1 to 1. It can go to really any number. If the beta, though, is equal to the market, meaning beta is perfectly correlated with the market, it would have a beta of 1. So 1 is, as we remember, the perfect positive correlation. If the stock moves in the exact same way that the market moves, that's going to have a beta of 1. So 1 means you're equal to the market risk. So stocks can have a positive or negative beta, and they don't have to stop at 1. So stocks could have a beta of 3, a beta of -5, a beta of 10, although most stocks live between a beta of, I would say, 2 to -1 or -0.5 would probably be at least 80% of the stocks in the market. Most stocks have positive betas, but some stocks could have negative betas. So this is going to indicate the stock's return is going to be, if the stock's return is positive in relationship to the market, so the market moves up, the stock moves up, which most stocks move up when the market moves up, so most stocks have positive betas. But there are a few stocks that would move in a negative direction. So if your investment was some sort of short position against the market, then that would have a negative beta related to the market. And like we said here, this is saying most stocks are going to be, I say 2, but they say 1.75 to 0.5. Right, so most stocks would be 0.5 to 1.75, but probably 90% of stocks are between -0.5 and 2. So the range really doesn't go much beyond that. Okay, so let's look at 3 different betas here. +2, +1, and +0.5, 0.5. So if it's a beta 2, if the stock market goes up 10%, your stock goes up 20%. It's twice as reactive. A beta of 1, if the stock market goes up 10%, your stock goes up 10%. A beta of 0.5 is half as responsive. So if the market goes up 10%, your return will only be 5%. Now, if there are negative betas, if the stock market moves up 10%, your stock is going to move down in 5% in the 0.5. And a -1, if the stock market moves up 10%, your stock moves down 10%. The negative beta of 2, if the stock market moves up 10%, your stock moves down 20%, twice as responsive. Here are some betas of some stocks. Now these change quite frequently, so these were the betas at this particular time. You can see that some companies have betas less than 1, but most companies will have a beta greater than 1. And you can easily use most financial sites like Yahoo Finance, Google Finance, Market Watch. They will give you the ability to look up the beta of a stock quite easily. Now, if we're measuring the undiversifiable risk, we could use beta to apply to the market. Now, this particular part of the slide is what I was talking about before, as far as market goes up 10%, a stock with a beta of 1.5, that stock would go up 15%. If the stock market fell 10%, a beta of 1.5 means that your stock would go down 15%. So it's just a relative measure of fluctuation of your stock compared to the market. So any beta with greater than a 1 is going to be more responsive than the average market fluctuations, or more risky. So the market is, a movement of the market is going to be an average movement of, say, 500 different stocks, if we're looking at the S&P 500 as the market. So you would see that most stocks individually would tend to be more responsive than the average of 500 stocks. That's why most stocks have a beta greater than 5. But there are some stocks with beta less than 1, and they're less risky than the average stock or this average market. Now, the capital asset pricing model will draw the connection between the beta and the expected return. So this is a model that we could use the beta coefficient to quantify the relationship of the risk and returns of a stock or a portfolio, depending on what type of asset you want to look at. So basically, this is the nomenclature of the formula, but if we write it out, we're trying to discover what is the expected rate of return, and that's denoted by J. So R to the J is the expected rate of return. A lot of times, some books will use K, so don't get hung up too much on the symbols. It's more about knowing the name of what it represents. So we're looking for, and what does that mean, expected return? This is something where we're going to look at certain variables such as the market, the risk-free rate, and the beta to calculate what we should be getting as the return based on the risks we're assuming. So how to calculate this? Well, we want to take we'll start on the inside and work our way out. First, we want to take the return of the market, the expected market return, and we want to subtract out the risk-free rate, because we don't want to amplify the risk-free rate, because we're going to multiply this by beta. So we want beta only to amplify the part of the market return that does not include the risk-free rate. So the market return is going to include risk-free rate. So that's why we want to subtract it out and just get a true market return without the risk-free rate, multiply it by beta, thereby amplifying the beta's effect on the market, and then adding back the risk-free rate unamplified later to get the expected return on the stock. Now, again, so since beta is easily to be displayed graphically, we can also use something that is called the security market line. So this will graphically show the expected returns on the y-axis to any given security on the beta on the x-axis. So for each level of this undiversifiable risk, the security market line is going to show the return the investor could expect in the marketplace. So it's basically a graphical representation of how beta is affecting the stock price through the calculation of the capital asset pricing model, which I'll show you that graphic a little bit later. Okay, so here we have, let's use the capital asset pricing model and beta to calculate the expected return. So we're going to graph the security market line. So we're going to think about Bank of America, which is a beta of 1.2, and we're going to look at different investment decisions. Now, we're going to assume for these examples that the risk-free rate is always 2 and the market return is 8. So let's look at a situation where we have Bank of America have a beta of 1.2, a beta of 1, and a beta of 2. Now, so let's just go over here. So here would be the beta and then the required return. So we're going to graph these later. So if the beta was 0, the required return would be 2%. Why is it 2%? Because that is the risk-free rate. So if there's no, if the beta is absolutely 0, then we should just get the risk-free rate. As the beta moves up for 0, we're moving closer towards the market return. So 1 represents the market return. And back here, it was denoted the market return is 8%. So beta 1 is the market return. So beta of 2, based on the fact that we're only amplifying the market return less the tax-free rate, we don't see a doubling from 8 to 16 because we took out that 2%. Okay, so this is the beta for different various potential betas, and then it's required return based on the change in that beta. So this is what we're going to plot on the chart to see the risk and how the risk premium changes. So here we go. Here's the security market line. So risk-free rate is at 0. We are expecting a 2% return. If the beta moves to 1, we're looking for an 8% return, which is 6% risk premium, 2% risk-free. So the 2% here, 0 to 2 plus 2 to 8 that's how you get that 6%. So a beta of 1, we're expecting a return of 8%, which is the market return. If beta moves to 2, then we have that risk-free rate 2% plus the risk premium of 12%, giving us 14%. So if we plot the 1 and the 2 together, we see, and we draw a line through these 2 points, this becomes a security market line. And we're graphically looking at, as beta increases, how quickly does the required return increase? Okay. So why is the capital asset pricing model so useful? It gives us an idea of what the return should be for the stock based on the risk. So when we do other analysis, we will be able to tell, if we're looking at sales and profits and do a more traditional analysis, we can kind of think to ourselves, we have the idea that we should be compensated by, say, 18% based on the capital asset pricing model. Does this stock look like it's likely to return 18% to us? Or we could look at it in historical terms. If the required rate of return was 18%, but the stock only returned 10%, then we're really not getting the return we deserve for the risks that we were taking. Now, there are some limitations to the capital asset pricing model. It's going to require an estimate of beta, which comes from historical data. So historical data is not an accurate predictor of future data. So the beta we're looking at is based on past data. So that may not reoccur. Beta may change and probably will change over the next 1 to 5 years. So these estimates of historical data, it's not going to accurately reflect where the company's stock price will be in the future. Now, it is a useful framework for evaluating risk and return, and it's an important tool that a lot of investors use, and it is widely used in business to look at the risks of different companies and the required rates of return. So it has a value to give you a construct of what the risks are of a stock and the potential or required return you need to compensate you for those risks. So at the end of the year, if your return on that stock is less than the required return, you weren't really fully compensated for the risks you took on. And that's because things change, Now, let's move on to the next segment, which is traditional versus modern portfolio management. So we have a very traditional way of portfolio management we're going to talk about, and then we're going to talk about a more modern portfolio theory and reconcile the difference between these two approaches. And because things change through time and we're always looking for new tools to help us manage our portfolios. So let's just go back to where it all started with a traditional approach. So here in the traditional approach, we're going to look at creating a balanced portfolio by assembling a wide variety of stocks or bonds. Now, we're going to look to create diversification by buying stocks of different industries. So we don't want to create a portfolio that are all the stocks in the semiconductor industry, because that would not be a very balanced portfolio. So we're going to look at or emphasize securities of companies from many different types of business to build a portfolio. So, and we're going to focus mostly on the well-known companies, the big brands, which it's been traditionally to perceive bigger, well-established companies are less risky. And these bigger companies, which has a lot of shares trading, to be more liquid and provide a certain amount of what they call, what comfort for an investor, or window dressing, which means that when an investor looks at a mutual fund, they see companies that they recognize and they feel more comfortable with this mutual fund because they know the companies and what they do. So this is a very traditional approach of portfolio building, especially in stocks. Now, let's look at a growth fund of the Growth Fund of America. And so this is going to be built in a more traditional approach of this portfolio. So at the time, it's saying that this is value of this portfolio is close to 200 million, of which 80% are U.S. equities and about 12% non-U.S. equities and 7 or 8% in cash. So we can see that the percentage of sectors, this is the percentage of different industries that the mutual fund is assembling. So it's a little heavy on technology and consumer discretionary and healthcare, and then some of the others. So this is just a very traditional type of mutual fund. Now this is figure 5.7. So in 5.7, we're going to plot the annual growth from 2013 to 2018 of two large mutual funds: the Growth Fund of America and the Fidelity Contra Fund, which is a very big, multi-billion-dollar fund. So the fund's returns are very highly correlated because they have very similar portfolio of big companies in their mix. So both funds probably have a lot of companies from the S&P 500 or the Dow 30 inside of their mutual fund here, and you see that owning either of them, you're getting very similar returns because they're made in very traditional portfolios. So this is not much to the traditional sense of portfolio construction. It's just very common sense. Build a stable portfolio of 50 companies that are very well known, that are large, that are have good products, good management, and you make sure they're diversified among many different industries. And this way you can build a safer, lower risk, higher return type of portfolio. However, in the modern portfolio theory, we're going to bring a little bit more finesse into portfolio creation. So we're going to use some of the stuff we talked about before: expected returns, standard deviations, and correlations, to help build a portfolio using more mathematical terms. So we're going to use combinations of investments to mathematically get to the optimal portfolio. So in the modern portfolio theory, we're going to use more mathematical principles to create a portfolio. And we're hoping that the benefits of diversification are going to occur, and investors will find securities that are relatively uncorrelated to combined in these new portfolios. So one of the mathematical tools we could use is called an efficient frontier. So this is looking at any given number of possible portfolios to be constructed from hundreds of investments available at any particular time. And this is why we utilize a lot of computer modeling when we're doing this. So we're trying to create these sets of possible portfolios to see what set of portfolios would produce the lowest amount of risk with the highest amount of return that we could plot on an efficient frontier. So we're going to look at the trade-off between risk and return of these different portfolios to get the most efficient portfolio, which is going to be in the frontier edge of the data, which we're going to show graphically in a second. Now these portfolios on the frontier are going to have the highest returns for the same risk. So there's going to be one point that's going to have the highest amount of return for that risk level. And then some portfolios will be in a more unfeasible sector, which we'd want to stay away from. So let's look at the graphic of this. Here's the graphic. Okay, so we have these, each letter represents a different portfolio. So portfolio B is more efficient than portfolio T, because this is the risk going up and this is the returns going up. So portfolio B has the same return as T, but less risk. So less risk, if you pull this down here, much less risk. Now portfolio A has a lower return and higher risk. So this is not efficient. These are in the blue area. These are all feasible sets in the shaded blue area. The sets, these A, F, E, and D are the least efficient, where B, Y, O, Z, and C are more efficient, with O being the highest amount of return for this particular level of risk. It's not the overall highest return. C would have the highest return, but also a higher risk. So O, this portfolio combination by letter O would be the efficient frontier of all the portfolios put together. And these lines 1, 2, and 3 show the increasing utility of the portfolios. So basically we made combinations from A to Z and plotted them on a graph, and we could see which group of stocks would be the most efficient portfolio. And that's sort of what the goal of what we're trying to do is let's assemble as many different portfolios as possible, mathematically, using computers, using all the data we can input, let the computer crunch all the numbers, and then graphically represent what portfolio would be the best combination. Now, the difference between the modern and traditional is some mutual fund managers feel like traditional stock picking and selection of stocks are the best way to make a portfolio. And some mutual fund managers feel that utilizing more statistical mathematical models to use the math to create the portfolios would be a much more efficient, with a higher return, lower risk type of portfolio. The truth is that the results have been mixed. Some traditional portfolios do better than some portfolios built in the modern concepts, and vice versa. Now, let's talk more about this figure 8. So let's look at these 1, 2, and 3 increasing utility. So these are different curves, the 1, 2, and 3. These indicate a given level of utility based on a set of risk-return combinations, which an investor would be indifferent. Now, the optimal portfolio O, so this is where I was saying here O is the optimal portfolio, and this is going to be a point at which the investor, like I was saying before, has the highest level of return for a given risk. So it's the highest level of the best constructed portfolio is what we're saying. And it's the best level, what they're saying here, satisfaction investor can achieve given the available set of portfolios. So given the available number of stocks and the available number of portfolios that have been created with those stocks, O on this chart would be the most optimal portfolio to assemble. Okay. Now, portfolio betas. We talked about before how to create a weighted beta of a portfolio. Now, you could look at the beta of the portfolio, and the goal is not to have a high beta because there's no reward for bearing a lot of diversifiable risk. So we would want to minimize the diversifiable risk. And that comes by diversifying the portfolio through a number of different investments. Now, beta is a measure of the undiversifiable risk. So the risk diversification can easily be taken care of by selecting and putting together a group of assets within a portfolio from a wide range of different industries. So it's really easy to mitigate the diversifiable risk. And you could do that with as little as 30 stocks. So the more securities you add to a portfolio, the more risk it declines until at a certain point, there's very little diversifiable risk left. So here would be a portfolio's total risk. So we have the diversifiable risk and the undiversifiable risk. Now, the diversifiable risk, you could see here at one stock, you have the highest amount of diversifiable risk. And that, as you move up until, say, 25 stocks, that continues to decline and then sort of only declines very slightly as you add more than 25 stocks. So you only really need about 25 stocks to eliminate most of the diversifiable risk. Now, the undiversifiable risk is not going to change no matter how many stocks you add. This is the market risk, such as inflation rates, growth rates of the economy, demographics. They're not going to change depending on what stock you own. So this risk is not going to change with the amount of stocks you add to a portfolio. But together they make up the total risk of a portfolio. So you could calculate a beta's portfolio, which is just the weighted average of the betas in the portfolio, which we've talked about these weighted averages in other chapters. And it's simply the weight of the asset times the beta of the asset added together for all the assets in the portfolio to create a weighted portfolio. And this is something I'll demonstrate in the spreadsheet how this can be calculated. But we could look at it here where we have, this would be the weights, the proportion of each stock in a portfolio. So these would be the weights. And this is the rate or the beta. So by multiplying the portions have to add up to 100%. So think of these as percentiles. We have 5 stocks. This is the breakdown of the 5 stocks, which gives us 100%. And the different betas of each of the stocks. And this would be a tech portfolio and a consumer portfolio. We would have a different mix of stocks and with different betas. So these are 2 different portfolios. Now, looking at the 2 approaches to traditional, we're going to stress more mutual fund managers who are going to spend more time in their security selection, getting to know the financials of the company, getting to know the management, the products, and they're going to try to pick the best companies and assemble them in a diversified portfolio across industry lines. So think about the traditional approach is not using a lot of math. It's just a lot of research. The modern portfolio theory is going to look more at the statistical representations or correlations between securities to find a mathematical solution to a portfolio that's going to minimize its diversifiable risk as best as possible. So again, it's going to be utilizing more statistical measures that we just kind of reviewed before, capital asset pricing model and betas, to try to put together a efficient portfolio based on the data available. Okay. Now, if we look at the 2 approaches, traditional and the modern portfolio approach, which technique should you use? Well, most portfolio managers, fund managers, are going to use a little of both. They probably would want to utilize the techniques of both to cover all their bases. That's not to say every mutual fund manager does that, but majority of them are going to utilize aspects of both. Now, so both approaches, this will help determine the risk that you're going to bear as a portfolio, creating a portfolio investment. So growth portfolios are going to have more risks than, say, income portfolios. Now, utilizing math, the modern portfolio approach, we could more easily put a number on that risk, such as beta or the required return. Now, seeking diversification among different types of securities across different security lines is more of a traditional approach that would take some research to know what companies fall into which industries, but you still want to look at the correlation between returns of those securities. And beta is what's going to help us, measure the correlation to keep the portfolio at an acceptable level of risk or an acceptable level of beta. Because we don't want to develop beta of 0, which means there's no risk, no return. And these fund managers are going to of course evaluate all these alternative portfolios to try to seek the highest return. So a traditional mutual fund manager probably has a mutual fund that already has 50 companies or more in it. And they're going to look and say, which companies should we remove? Which companies should we add? And has it overall affect or change the risk of the portfolio? And that's where they'll probably have somebody on staff, a statistician, who are going to put the mathematical data together and come out and do say this is, so the traditional. If he's more of a traditional guy, he might say this is the portfolio that I'm proposing, and then the mathematics or the modern portfolio theory, or people will come in and say, okay, here's the data on this. This is the portfolio beta, the required rate of return using capital asset pricing model, and it just gives some statistical measures, including percentages of representation of each industry. And they can make suggestions saying if you just swap out this company for that company, or buy more of this company and less of that company, we could change the overall, we can improve the overall level of risk and return in the portfolio. Okay, so that is the end of part 2 of chapter 5. I hope you enjoyed this time we had together, and I look forward to talking to you in the next chapter.